like to have
He moves his hands a lot, so he has trouble with the
yeah.
a mic.
Thanks.
Try and hook one up to him. Maybe. Yep.
Did he say just to leave him on?
I think he said just leave him out.
No, I can use yours. Yeah, absolutely. Yeah, talk me up.
I like that.
How's this sound? All right, does this sound okay? How is this?
Let's have a try. You might have to
All right. Okay, that's all right. Maybe it'll work. He's not sure.
Much better?
Ooh.
Would you?
Yeah, he thinks it might work. He's not sure.
Well, if not, we'll figure it out. Well, hello. We're ready, I think. Good morning, everyone. Thanks for joining us this morning in this panel about successful capital markets instruments to mobilize private capital into conservation. It is great to be here and have these great panelists, also friends after all our journey into the different structuring and issuance of the transactions we're going to talk about, to discuss and dissect two specific cases of successful bonds issued in the last year in the capital markets. My name is Avril Benchimol, and I lead the Blended Finance Initiative at the GEF. What this Blended Finance Initiative does is try to help mobilize private sector investment at scale with the use of debt guarantees or equity or performance-based instruments in order to bring the private sector investment that is much needed into conservation. The panel today is going to go into two transactions. First, the wildlife conservation bond that the GEF and the World Bank Group issued together this year. And second, we are going to have here the Nature Conservancy, Kevin Bender, to discuss the debt for nature swaps that have been issued also this year to, well, I guess Barbados was in the summer, but Belize was a year ago. So in order to discuss these very novel transactions that help create good and healthy sovereign debt profiles, but also secure conservation funding. I am moderating the panel, and then we will have a colleague, Alison Wright, who would close with closing remarks when we finish. But I would like to start asking our panelists to introduce themselves, and then I'll start with the questions. So maybe Michael, since I have you just close to me.
Okay, does this work? All right. My name's Michael Bennett. I'm the head of market solutions and structured finance at the World Bank Treasury.
Hi, I'm Steve Libertor. I am the head of ESG and impact for global fixed income at Nuveen.
I'm Kevin Bender. I'm the director of greening sovereign debt at the Nature Conservancy.
Thank you. And I am going to just deep dive, since we have 1 hour, and we hope to then have Q&A from the audience. To Michael, can you explain to us how the Wildlife Conservation Bond came to be, and how this is innovative in many ways, but also how within the multilateral development bank structure, how Treasury and the operational side happen to work together, and also with us, with the GEF as the funder of the payout. Thank you.
Yeah, so the Wildlife Conservation Bond, which has been referred generally in the press as the Rhino Bond, really interesting and important structure for us. We think it's a model that we could replicate going forward. This is maybe a difficult slide to go through, but I'll just talk through it in terms of starting with what was the goal here. And the goal here was really working with GEF as a donor, where in a traditional donor relationship funding a project like this, and this was a project aimed at various things, and importantly increasing the populations of the black rhino in 2 parks in South Africa, ordinarily GEF as a donor to a project like that would be putting money on an upfront basis and taking the risk of whether the project would succeed or fail. And what we wanted to do with this bond is see if we could take some of that risk of project success and take it off the donor and put it instead on capital markets investors. See if capital markets investors would take that sort of risk, and then allow GEF to be in a position of pay for success, where GEF only has to disperse their money at the end, and in this case it was a 5-year maturity of the bond. At the end, if the project is successful. If the project isn't successful, that lack of success is suffered by the capital markets investors, and GEF retains its money. We also, very importantly for this structure, wanted to make it something that real institutional investors could buy. So we weren't looking for them to provide us charity. This was not a philanthropy exercise. This was something where we wanted to structure a bond that could actually have a proper risk reward for investors and bring in real investors. And as you'll see, it's a $150 million bond, and so that's really is a very significant number for impact or outcome type bonds. So the basic structure is it's a 5-year bond. The World Bank is the issuer. We issue the bond to the investors. They obviously put up their money. And ordinarily in a bond, investors expect to receive ongoing interest, annually, semi-annually, quarterly. In this case, there's no ongoing interest of that type. So during the 5-year term of the bond, the investors don't receive any ongoing interest. Instead, that money that would otherwise be paid as interest goes to these 2 parks in South Africa for specific interventions aimed at a variety of things, including increasing the black rhino population. So it's that coupon or interest that the investors are giving up that funds the activities on the ground in South Africa to help the black rhino populations. At the 5-year maturity of the bond, the investors are guaranteed to get their money back because the World Bank has held that money and has invested it in our general sustainable development lending pool. So investors are guaranteed to get their money back, but up until this point they haven't received any coupon. So obviously that in itself is not a investable proposition. So at that point, at the 5-year point, is where the GEF conditional pay for success grant comes in. And that conditional grant is triggered by certain key performance metrics having been met in terms of black rhino population growth. And if those population growth have met the highest level of success, a certain payment is made from GEF through the World Bank to the investors. If it meets a different level of success, a different level of payment is made. And if there's been no success, if the population of black rhinos has decreased over the term, there's no additional success payment, and investors just get their money back. So to go a little deeper into the economics of this for investors, the rhino growth scenarios are average annual growth of black rhino populations across the 2 parks that received the funding produced by the bond. There was also, again, to make this an investable proposition for investors, we issued the bond at a level below par. So in other words, the bond was issued at about 94% of par, which means that at maturity, when the bond matures at 100%, there's a guaranteed minimum return of about 1% built in by the fact that it will accrue from 94% to 100%. So there is a guaranteed minimum return. Investors are guaranteed to get their money back. And then you can see in the orange column, the contingent success payment varies by success. So if higher than 4% growth is met, the payment is the full payment, and the tiers going down reduce the payment down to 0. And you can see then on the very far right of the slide, the bond yield per annum we're providing. Now this was issued, I believe, in March of last year, of this year, much lower interest rate environment. So, but at the time we issued the bond, that highest potential yield, 2.83%, was about 50 basis points, so about a half of a percentage point higher than investors would have received if they had bought just a typical 5-year World Bank bond. So investors had a chance to make better than they would on a typical World Bank bond, which is of course important to make this investable. And if the projects don't succeed, investors get no contingent success payment. They've taken the risk of the project. So that was what was important to us on this transaction.
Thank you. Thank you very much for that detailed explanation. And before I passed on to Kevin, can I go back to the slide, please, just on the payout? The interesting part of this whole transaction was that the GEF as a donor and an issuer that is AAA rated, like the World Bank Group, combined financing flows to create a bond that could attract the money of the big institutional investors that we're all seeking to attract for conservation. That's part of the bigger discussion we're having here at the COP on resource mobilization from private sector. And what's very important is what Michael mentioned. This bond has AAA rating for the principal, so the money at the end of 5 years will be paid back. And the GEF agrees to pay success payment that is directly linked to the rhino survival in 2 parks of South Africa. So that what's very innovative here is the combination of the 2 sources of funding, but also that the payout is directly linked to the conservation activities on the ground and how we measure, we disclose, and we have the metrics for that. So we will go back to that aspect of the transaction in a little bit. But I wanted to go to now Kevin, since you have been pioneering with the Nature Conservancy, and if we can get the other presentation up, with the Nature Conservancy on debt for nature swaps since many years ago, but it has evolved over the years from what we had originally have as a concept many years ago to what we've seen as very innovative transactions for Belize and Barbados and hopefully other to come. Can you please explain how the concept evolved during these last years and what these 2 transactions are why these 2 transactions are important and why they fit the priorities of the governments of these 2 countries? Thanks.
Sure, thanks. I think the slides are more for later, but we can go right into it if you want. We can.
I was just thinking, yeah, maybe that since we went into
sure.
The deep dive, we can.
Either way, doesn't matter. So what we were doing with these, you asked about the evolution of this. We're all, as of now, all of the transactions have been marine-based. So we're working on getting to 30% protection, and we're working with countries that have the targets to get to the 30%, but don't have the financing, and we work with them on the Nature Conservancy side on the conservation and the science to get there with the marine spatial planning and the like. But doing all of that doesn't mean anything if the government doesn't have the cash flow to pay to cover those costs. So we're trying to create the cash flow to get those done. These evolved out of the straightforward, what everybody calls debt for nature swaps, which were bilateral agreements where one country is a lender, agrees to get rid of the debt, and then the country puts that debt, those debt payments and the debt service into a conservation program, usually a forest or a coral reef. Those were very popular in the 1990s. TNC did our first, in 1990s and 2000s. And we did our first transaction with the debt for nature swaps in Belize, actually, to do a forest in the south. Those kind of got pushed out with the HIPC initiative, right? Because the criticism was they were very difficult and it was hard to get it took years to get it done. And with HIPC, it was just a forgiveness of money without any conditionality, so it kind of moved on. They're still around, but they're not as popular as they used to be. When we did our next step in the evolution was to go to Seychelles, and the Seychelles was a similar thing because it was with the Paris Club. So it was bilateral debt. and it was several countries in the Paris Club. We started working with Seychelles a few years earlier, and by the time we got around to closing the transaction, Seychelles was in much better financial shape than they were when we started. So there was less interest from the bilaterals to forgive the debt. So we started with an $80 million transaction, and we ended up with about a $22 million transaction, so it shrunk. And the discount shrunk because of the credit strengthening of the Seychelles. So because that was smaller, that was a large success on the conservation side, in which the Seychelles did commit to 30% protection. But we didn't create enough financing. And then a knock-on effect of that was the Seychelles came out and did the World Bank Guarantee Blue Bond later, which these two can talk about. So learning the lessons from that was we wanted to find the discount in the market, on the debt, and the capital markets were providing discount on a minute-by-minute basis. So we could see where the debt was trading. So when we went to Belize, we had been talking to Belize about it in the past, but when I first started talking to Belize, which was it was a new administration, and it was the end of 2020, and we closed this in November of 2021. Belize was in a debt workout situation. They were capitalizing their bond interest, and the debt was trading between 38 and 40 cents on the dollar. So that was a huge discount. Well, by the time we got to through the negotiations, and this was not our negotiation, this was with the bondholders and their advisors, Citibank and Belize, the bondholders agreed, in part because of the conservation component of it, to sell the debt at a discount at around 51 cents on the dollar. So that was a huge, if you read our case study, it's 55 cents, but there was capitalized interest in that. But it was roughly almost half was a discount. So all that discount gave us plenty of room to create the savings, and the savings is what goes into fund the conservation. So as we refinanced that into a loan, we gave them, we made a loan through our SPV, and I can go to the structure, but they use that money to pay back the bondholders, right? Not to put the money into conservation, and then the savings creates the conservation. And that savings goes along with the new loan, so it is sustainable finance. There were quarterly payments to Belize, and those come through. We can go through the transaction, I think, later. Okay. And then the Barbados structure is slightly different. But it's very similar, but it's slightly different on the credit enhancement, and that's what I think we can go into in a bit. But the key thing was that we took with the credit enhancement of the United States government of DFC, which was an arbitral award default cover insurance policy on our loan, we were allowed to issue bonds in the market to the AA bond market, which is a much larger investor pool. Moody's rated it AA2. And we went from the emerging market financing sector is much smaller than the investment grade world, but then when you look at the investors who do the high end risk end of the emerging market, the Belize investors, it's a very small pool. So we're taking it from the small investor world to the large investor world through credit enhancement, and then we also had, and I'll go through that in a minute, but significant assistance to the government on reducing their debt service, their debt service burden, and their principal outstanding, which led to and within a week, they were upgraded by S&P from selective default to single B.
It's really one of these great stories of sovereign debt that was held by a single transaction, right? Like on how a country can restructure the debt hurdles that they have, but at the same time secure the conservation funding. And we will get into, as you say, the details of the transaction. But here with us we have Stephen from Nuveen, a pension fund, or one of these big institutional investors that we seek to mobilize into conservation, and that is so hard for the conservation community and for nature-based assets and nature-based solutions to bring into the table. So we can't wait to hear from you about what was in the wildlife conservation bond and also in the original Seychelles sovereign bond. How did these two bonds manage to get your investment? What was important for you in taking that decision?
First off, thanks for having me. I think that for us, as I mentioned, I'm our lead PM for all of our dedicated ESG and impact strategies. So for everything that we do is focused on what our investors are looking for. So next to attractive long-term total return, they're looking to make direct and measurable impact. So these types of transactions really speak to the goal that our investor has of having good long-term results, but through doing that through the providing of capital to issuers and or issues that have a positive environmental and or social outcome associated with it. So when we look at these different types of transactions, we look for opportunities first and foremost from a return perspective, but then also to see what type of impact is really being made. Is it direct? Is it measurable? Is it something that we believe will help lower the cost of capital for these types of transactions going forward? Is it scalable? Is it a template-like transaction? Can it be replicated in the future? And so for us, when we look at these, we're trying to look at it more holistically from the lens of not just attractive total return, but how are we able to deploy our capital, our investors' capital, in a way that will generate an outcome that we know they're interested in seeing and evaluating, but also then translating that into the next set of issues or transactions, so that, again, this capital can be leveraged and reduce the cost of capital for these types of transactions going forward, so more of them are done and you create a virtuous cycle. So for us in these transactions, and we, the original World Bank Seychelles Blue Bond, we were the lead investor. We were the lead on the Rhino Bond, and we also participated in the Barbados Blue Bond. Those are transactions that we felt had the additionality, the intentionality that we look for in transactions. There's excellent reporting, and most importantly, we were able to lever the expertise of the World Bank, of the Nature Conservancy, and the people that work there, in order for us to get comfortable with what is really trying to be done with the proceeds. I've been managing these types of strategies for 20 years. I manage about $20 billion, but I am not an environmental scientist. So I need to be able to have the technical expertise that the World Bank brings, that the Nature Conservancy brings, to be able to get comfortable with understanding what am I looking at. I know nothing about the gestation period of a black rhino, so I needed to be able to talk to people who did, so that we could get comfortable with the metrics that are being shown. Are those achievable? Are they reasonable? What are the current growth rates? What are expectations? What is the focus of South Africa for providing protection and focusing growth on the rhino? But then also getting into, what is the support at the park level, the surrounding communities? And it's always, to me, the most interesting part of that particular assessment was talking to the rangers, and then talking to the local leaders of the communities who viewed the opportunity to grow the rhino population not just as their it's almost, they feel like it's their responsibility because it's their environment, but they recognize that the parks are economic vehicles for growth. And you talk to people and they're like, well, we want to, not only, we see this not only as an opportunity for growth in employment, but we want to see a diversification of rangers into more female rangers, for example. So you see that, to me, it becomes more and more clear when you look at these types of transactions that we're finally getting to a place where we're tying the environment, conservation into economic growth, because they are inherently linked, but we've always treated them as distinct entities up until more recently.
Indeed, and that's great to hear from a pension fund, because that's exactly what we're trying to convey from the conservation and the environmental side, to make the case, the business case, and ingrain the economic value of these investments to attract additional capital from private sector. But in this case, and I want to turn to Michael, when you had conversations, when you tried to sell the rhino, or when we are about to issue the rhino bond or the wildlife conservation bond, what were the questions? What was the type of education that needed to happen so that investors like Levine, but also other investment banks or the insurance companies, were asking in order to assess the risk and return of this transaction?
Yeah, it was a very interesting educational process and investor relations process with something like this, because as Steve mentioned, I think there's a lot of interest from the underlying investors that all these institutions have in supporting specific outcomes, knowing exactly what their money goes to, and that's not always easy, even for those of you who know the green bond space. green bonds has become a very successful market, but for investor in a green bond, a typical green bond, you won't know exactly where your money's going. You might know the kind of activities it's supporting, you won't know exactly where it's going. These transactions will tell you with much more specificity where your dollar or yen or euro is going. And so they have, I think, a significant appeal to investors. On the other side, they require a lot from the investor in terms of analysis, as Steve mentioned. I mean, when we started the Rhino bond marketing process, it's fair to say there are no institutional investors in the world who had a very strong opinion about the likely growth rate of black rhinos in South Africa, or would know anything about that. So we spent a lot of time answering questions, bringing in our experts from the World Bank, and Ellison is here as one of our experts from the environment area. We'll make a few remarks at the end. So bringing in our experts, facilitating conversations at the park level for them to understand, because again, we were not looking at this as philanthropy. For philanthropy, maybe you can just tell people, this money will help the black rhino, can we put you down for $1 million or $100 contribution? This was not philanthropy, this was an investment, and we very specifically made it an investment. And therefore, the investors had to do this due diligence. And it's just an entirely new form of due diligence, but still it's traditional investment work. And it was, I think, fair to say, we asked a lot of our investors. And in the end, we had Nuveen as our lead investor, maybe 10 or 11 other investors in the deal to some extent or another. And we admittedly asked a lot of them in terms of doing the analysis. But I think there's enough investors like Steve in the world who are sufficiently interested in these kind of products that they're willing to do that work if you give them something that seems like it has a robust structure behind it.
Thank you, Michael. And before passing on to Kevin for the deep dive into the Belize and Barbados, Stephen, what type of model, how did you assess the risk? What were the tools needed for you to assess the risk to finally, bring it to your investment committee and say, we're moving forward with this? What was needed and what's important for the conservation professionals to be sure whenever we structure these types of bonds, the information and the data is available?
Yeah, so in this case, we've done a lot of blended finance transactions, and they can be very complex. In this particular case, you had multiple analyses you had to perform, first from an investment perspective, but then also from a conservation perspective. So we had to, do our general due diligence that we do on the World Bank, who we've worked with on a lot of transactions. We also had to do our assessment of the GEF and their ability to make good on their conservation success payment. And that was fairly straightforward because you're talking about two AAA entities, but you still have to do that assessment. And you got to do the relative value work of, illiquidity for this particular security and where does it tie out relative to the conservation payment. But a lot of the work that we did was really on the conservation side, where we were fortunate to be able to work with Ellison from the World Bank, who is clearly an expert in this area, and made it more comfortable for us to understand what the goals here were, what is reasonable, what is doable, and what type of support are you receiving on the ground from not just the parks but also the national government in South Africa and again the local communities. And so that was an important function because we had to get comfortable with that, understand the rhino, the growth rate of the rhino, the gestation period, all of that type of stuff. But then we also had to do due diligence on the calculation agent, which is Conservation Alpha, and understand what are their experience and expertise in this particular area, and then also, diligence on the Zoological Society of London to ensure that they were also a credible person to do the verification of the work Conservation Alpha was doing. So it takes a lot of time. And that's why I think it's so important that we structure things up front that can be template-like, and that we work with the issuers and we work with the investment banks up front so that all of this work that's done and not everyone can do this work. Not everyone wants to do this work. But if you do it, then you've set yourself up, hopefully, for future to being able to scale and do it more easily, and get to a place where deals don't take 9 months or a year to get done. They can be done far more quickly. But all of that work is something that's critical and important, and that's why I think one of the things that I try to talk to, I tell our investors, or when I'm asked, one of the more important things isn't just receiving AAA, guarantees or AAA payments. It's getting access to the experts that have technical knowledge and can communicate that to you and be able to help you understand the data you're going to be receiving, and is that good, is that bad, and that's why you're fortunate, and when we look for transactions, we're looking for World Bank, GEF, TNC type of involvement, because they have a lot of expertise and a lot of credibility in the space.
Yes, indeed. Thank you. And in this, in this specific case, the expertise of TNC and the long-standing relationship in Belize, I understand, was key to do the debt restructuring and the whole conservation trust fund. So if we could get into the deep dive of that transaction and also the Barbados transaction, it would be great to hear from you, Kevin.
Sure, and I would echo what Steve is saying, that the key to making this work on the financing side is the credit enhancement. But the key to getting the credit enhancement is the conservation. So DFC and the investors like Steve need to have comfort that what the conservation that we're promising is going to get done. And the way we do it, and I'll go through it quickly, is much different than what Climate Bonds Initiative is doing. They want something that's easily auditable by Price Waterhouse, and it's all the same, and people can check a box, which is nice for the investors. Our program is not like that. It's much more hands-on, but it gives, I would argue, even more comfort, because TNC's mission is to get this done. We're on the ground in Belize. We've been there for 3 decades, and we plan to be there for 3 more decades. So that is key to it. It's a nice structure that really puts a lot of onus on getting the transaction accomplished on the conservation side. So if we look at what we're doing in TNC, in Belize, and in any of these deals, we're making a loan to the government, right? And this loan is pari passu with their bonds and the like. So there's a lot of risk of default. If they default on this, it costs them greatly, right? So there's a lot of legal strength behind the commitments that the government is making. And we we work on the biodiversity plan with the government. We work on a marine spatial plan with the government, and a marine spatial plan is exactly what it sounds like. It's not a conservation plan. It just maps out the ocean area and how it's used, and then we do that so we can put the conservation areas of the 30% into that plan, and that's a heavy scientific stakeholder process that TNC is running on the ground in Belize and the Seychelles and in Barbados. Then we set up a conservation fund. So the funds that go from the savings that go into conservation go through an independent conservation fund that is not part of the government budget. So it can't be changed the next year, and it can't be, the government can't run roughshod over it. But the government is heavily involved. They usually have a minority control of the board. So if there's 9 seats, they'll have 4. And usually those 4 seats are the Ministry of Finance, the Ministry of Environment, Ministry of Blue Economy, and then the private sector and the NGO sector and different other stakeholders would be there. And TNC will keep 1 seat out of 9, as whole 1 seat as well. And then there's the conservation commitments of the 30% that are usually time bound. Belize was at just under 16%, and they were to go to 30% in 3 steps up until 2026, I think it was. So those 5 things, those 3 steps in the conservation and the marine spatial planning and the conservation fund, the establishment of that, and a few other things are in the document, the loan document. So if they don't achieve those by a certain time, and then there's a grace period and it's at TNC's discretion, and we work with them to get these achievements accomplished, the government will incur additional payments while the milestones are not met. So if it's out for a year, they'll pay a year's worth of additional payments. It's not a sustainability-linked bond for those who are in the market. It doesn't go to the bondholders. The bondholders do not get any difference whether it's a success or a failure. That money simply goes into an escrow account, and we want to encourage the government to get these done, and we're actively working to get these milestones done. Once they achieve it, the money and whatever interest is paid goes back to the government. If they're never achieved, then it goes into an endowment that we're also building. On the financing side, quickly, Belize was almost too successful for my taste, because what we accomplished in Belize on the financing side with the government balance sheet and the IMF was a very big win. They had amalgamated all of their debt into one bond. They called it the super bond over a year, and then they defaulted on that bond. They got out of default, and they were defaulting again. So this was all of Belize's hard currency commercial market funding, borrowing was in the super bond. And we refinanced all of that. That was $550 million worth of debt that we refinanced down to $364 million with our loan. So they got a large $190 million of debt written off, and that's where the credit rating came back. Plus, it was a smaller amount, and they were paying debt, so their debt service in the future was lessened. And we had a step-up structure on the coupon. And we did this because we needed to get paid back as well. And Belize was in, Belize is a tourist-based economy. They had gone through COVID. They were in difficult times. The last thing of note, I think, would be that we did have what you see a lot, and in the Caribbean, in emerging market bonds, there is a chance to defer the payments of the debt payments on their bonds in the event that a hurricane hits, or if there's some other type of situation that happens that affects the economy on such a great basis. We don't want to put that into our AA investor world because they're not emerging market investors, and we want to have different investors. A quick aside on that is, I'd echo what Steve was saying, that we want to make these products as plain vanilla, they call them in the market, as possible, as simple and as everyday and commonplace. So no one's winning awards on this. They just go to the market clears, and we finance those. Right now, we're not there yet, but I have 100% confidence that we can get there. It's just going to take a few more iterations. What we don't want to do is put things like a parametric clause into these AA paper transactions. So we set up a parametric insurance policy that the structure pays directly into our SPV, and our SPV buys the policy. If the clause triggers, then the subsidiary Munich Re just pays the SPV, and the bond the coupon is covered. So we are working on addressing the problems, but trying to make them as far away from the market as possible, and it's quite doable. So I'm hesitant to put this slide up because it's very complicated, but if you just look at this is the structure. It kind of starts in the middle with our SPV that we created. In this transaction, this was a TNC controlled the SPV. We're kind of moving away from that and making it more traditional SPV structure. And that, because TNC is involved, that structure gets, if you could see, the DFC credit wrap, the DFC arbitral award default cover, and the parametric insurance go to that entity. That entity lends the money to the government of Belize, so then the government of Belize can pay the bondholders and retire the debt. If you see, there's I don't think you can see, but there's a web address on there. We have a case study that goes into 10 pages of this if you're interested, but the first page is a nice summary. And then that entity is financed through the capital markets, through Credit Suisse had was the arranger of this debt, and they created an SPV that issued bonds into the market, and that, because of the financial flow of SPV, we got the AA rating on, not sure, and then that was passed on to the bondholders. So that allowed us to borrow at a much cheaper rate, and as I mentioned earlier, the difference was in the rating of the bonds that Belize had. The super bond was CAA3, CAA2, I think, and the blue bonds were issued at AA2. So for those in the market, that is a 16-step, I think, increase on the rating, which makes the whole dynamics work and creates the savings. So as Belize pays back that debt. The money goes into the SPV, and then the SPV sends the money to the conservation fund for the conservation activity on the ground. Was on average over $4 million a year, which was tripling the budget that they had for marine conservation. And then we also build an endowment. Usually we build an endowment slowly, but Belize, in this case, borrowed money in our loan to put into an endowment that would grow over the 19 years of the structure, and then that will replicate the payments going forward. So it doesn't just end in 19 years. There would be enough, and if it grows as we expect with a 7% interest, it would be sufficient to replicate the cash flows going on long into the future. And then if you can see, TNC did put in this case, a small equity contribution to help the dynamics, which really wasn't an equity. It was a low interest loan of $10.5 million to make the financing work. Quickly on the Barbados structure, this was a different structure in that we, in the Belize structure, we used a complicated, great product, but a complicated product takes a while to understand by investors. Steve can attest to that because I know he spent some time looking at it, and it was arbitral award default cover, meaning basically if Belize were to default on us, we'd take them to the arbitration, and when we win in arbitration, if Belize doesn't pay us right after that, then the U.S. government would pay us that money, and we would pay the bondholders, and the bond would be retired or closed. The problem with that is we have to get through arbitration with our bondholders, so we had to create a large debt service reserve account, which we can do in these structures with the additional borrowing, but in the Barbados case, they were guarantees, right? So the guarantee eliminates all that time lag, and the guarantee structure was really two different things, two different components of this. The one part was retiring Belize Euro bonds that were dollar denominated, and we were also retiring Belize domestic debt that was in Barbadian dollars, and it was about just almost a 50-50 split of the 150 million between the two. So we issued also with Credit Suisse on this transaction through the bond market. We raised the dollars, and then CIBC First Caribbean made a loan in the local currency to cover to buy out the other half. Both of those were guaranteed in two tranches. Roughly 2/3 was guaranteed by the Inter-American Development Bank, and then TNC, and we're credit rated by Moody's and S&P. We're AA rated. IADB is AAA rated. So there were two tranches of that debt, and on both of the currency sides, and investors could decide which tranche they wanted to go into. And on both of those, the structure on the conservation side and the conservation fund, MSP, and all that was almost identical in the two transactions.
Great. Thanks, Kevin. For those usually in the audience that we talk about, even my colleagues at the GEF, when we talk about these very complicated or looking like complicated structures, I think what's important here is that the financial innovation that can happen at structuring a bond like the Barbados, Belize, or the Wildlife Conservation Bond can address and attract already today without, I would say, or without having yet from COP15 the guidance and framework and all of the policy that is needed to unlock finance at scale. It is possible to attract private sector investment. It's possible to attract what we call Wall Street, right? Investors would look into countries that do not have the credit profiles that we usually look into for a pension fund, for example. So these structuring, which can be complicated, require the understanding of what the finance is, but also the conservation, and that's where TNC, where the World Bank Group, what the GEF have and bring to the table and bridge the gap, the understanding of the both worlds, the finance, but also the conservation, how that can work. Moving, I would say, if lately we've seen a lot of comments from the IMF you were mentioning, and also calls from governments and parties to do more of this. Can we do more? What do we need to do more of these types of transactions? On the structuring side, bringing it to the more plain vanilla, if possible. And from the investor side, or from a Treasury perspective, how do we need to structure this and make this a very effective tool for resource mobilization from the private sector?
You want me to go first? Sure. I think even with these few data points that we have of the 3 transactions we're talking about, 4 if you count Seychelles, but getting it into the capital markets world, it's a solution that we need, right? Because with climate change and what's going on with biodiversity, there's not going to be enough public money out there to solve these problems. So we do need to be clever and use the public money to leverage the private sector. And that's everybody's dream of innovation. And it's working. I don't see a problem with sorting out the complexities to get to plain vanilla. We'll do that. It'll take a few transactions, but it won't be a heavy lift. There is an enormous amount of demand on the countryside because there are countries that just do not have, recently interest rates were very high. They've come down a little bit, but many countries were just priced out of the market for any type of borrowing, not climate or biodiversity specific, but budget and the like. And you saw quite a few countries. Now, IMF was reporting that I think 60% of emerging markets and low-income countries were in debt distress or near debt distress, and the numbers are high. So we do need solutions just to get these countries into the market. Like I said, the interest on the countryside is very high. The interest on the country advisors, the Lazards and the Rothschilds of this world that advise countries on this is very high. The interest from the market is fine. I'm not worried about it. We can get the structures right, and we can tap into X% of the AA or investment grade market. That's not a problem. The limiting factor for me is the credit enhancement. So the credit enhancement has to. Everybody wants credit enhancement. Everybody wants cheap money, and credit enhancement can be very efficient with the relationships that the World Bank and the IDB and have with governments to get this. So we need to demonstrate, and I think I've done it in my own mind. I'm convinced that it's more efficient to go out and leverage these into and tap into the capital markets than to just do concessional loans or grants. If you read the IMF statement, the managing director is very clear to say there are times when a grant and concessional financing is the way to go, and you can't argue with that. But there are times when it's not, and we can, we can really tap into a much larger, and I'm talking scales of tens of billions of dollars larger, onto these transactions. I'm not concerned about that. One of the criticisms we have, if we think about it, is if you do a concessional loan for $100 million into financing, you're putting $100 million into biodiversity, right? If it's just for that and climate. Ours do not do that. We're not what's called a use of proceeds bond. We're creating the savings from the debt conversion and putting that into the biodiversity. The difference is, one, you get less money, you get less bang for your buck, but you get no increase and oftentimes a decrease in the debt outstanding. If you give a concessional loan to country X for biodiversity, you're increasing their debt outstanding $100 million. It's that simple. Whereas like in Belize, we dropped it $190 million.
And that's what we call a win-win situation. Win for the government and the restructuring of the debt and the debt health of these countries that are in distress, and also for conservation. Stephen, what's your take?
I would concur. I think that the 2 different structures that Kevin had up are good examples of the progression that we've seen in the marketplace. And for us, we did not we spent a long time looking at the Belize deal. We did not participate in that, but the Barbados deal, we own the entire TNC tranche and the majority of the ADB tranche. So for us, when we looked at the transactions, there were significant improvements in our view, from transaction to transaction, that got us comfortable. And I do think that the key is, again, trying to scale it will be some level of simplicity and template-like structures that, in the next deal you can, if we look at the Barbados transaction, it doesn't need to be Barbados, it can be Fiji, right? And it doesn't need to be the TNC and IADB, it can be the Rockefeller Foundation and the Asian Development Bank, whatever it might be. And those structures, I think, allow for the leveraging of private capital, because when we evaluate the transaction, we're not anticipating getting paid back by the IADB or the TNC. We're going to get paid back by Barbados. So for us, we think that that's the way to look at the transaction and allow for a leveraging of what we would consider blended finance and this capital in a way that can grow the market far more rapidly than what we have seen to date. And because there isn't enough concessionary capital to meet these needs, you're going to need to be able to bring it, you need to be able to structure investments that have market level returns to be able to get there with the amount of capital that's needed. But hopefully what we're doing ultimately in all of this is we as investors and really as economies have done a tremendous job historically of valuing extraction. We're now finally getting to a place where and exploitation of natural resources. We're now finally getting to a place where we're starting to be able to value more accurately conservation and environmental focus.
I would just say, I think the key from the World Bank Treasury perspective anyway of this is actually reducing to the maximum extent possible the amount of credit enhancement, as Kevin was talking about, or donor resources that are required for a transaction. Because from our perspective, a 100% guaranteed transaction isn't really a leveraging transaction, because we're using the same amount of World Bank balance sheet, whether we make a 100 million loan or whether we do a 100 million guarantee, in terms of our credit exposure to a country. So if we were to do a 100% guarantee of a country for obligation, that would use up as much exposure limit as a direct loan, and we'd always have to compare the pricing of the two. And in every case, our loan is going to be cheaper. So although I agree with Kevin that creating AA and AAA securities, plain vanilla, has a lot of appeal, from my perspective, from where I sit, we would not do that in the form of a 100% guaranteed transaction. We think the trick of this is really how little credit support, how little donor resources can we use in each one of these transactions, how much risk can we start really passing to the capital markets investors. And in my mind, that comes from experience. So maybe we get Steve in the first deal with 100% credit enhancement or with quite a significant additional return. Steve has a good experience in that deal, and maybe the next time he requires a lower level of credit enhancement. And I think that's what we're going for at the World Bank, which sounds like it's a little bit different than, Kevin, what you folks at Nature Conservancy are looking at, but I think the two approaches definitely complement each other, and together they can help grow this market.
I do think also that what Michael's bringing up does relate back to discussions that I think, not telling them how to do their jobs for certain, require more discussions with regulators as well as rating agencies, for example, to get away from the concept that a 100% guarantee is equivalent to a 100% loan, and getting more to some type of risk-based capital assessment from a regulatory standpoint and or a rating standpoint, which would then allow for, again, the leveraging that we're talking about. Because again, as an investor, we underwrite to the end borrower, and we're not going to rely upon World Bank or TNC payment on Barbados. We're looking at it as we assume that Barbados is going to make the payment back.
I think that's a great point. And before we close the panel, we've called up to Ellison, I think the panelists and I, several times, because he sits, and professionals like this, and here at the TNC, at the GEF, at the World Bank, and these organizations, but also within the Credit Suisse of the world, of the Nuveen, these professionals sit at the cornerstone of understanding finance and understanding environment. And Ellison brings 20 years of experience in both. And I wanted him to give a closing remarks after hearing us talking.
Thank you, Avro. No, please stay seated here. We need you. So all I can say is, without Avro, there would be no here, okay? Without Steve, there would be no deal. And then Michael and his team, they love rhinos now. They love all wildlife, and they're waiting for a trip to South Africa. And on our side, I think, and by the way, Kevin, we love your work and we want more of it, and we want many, many more TNC colleagues out here. And we have colleagues from ZSL with us. Andrew here, if you say hello. They were essential to make this happen with the prior project that we built upon, as well as, you know, making this transaction. So the three things that I would say are, you know, we need to have everybody engage. And how we succeeded here, okay, where we have a transaction to critique and say this is, call it beta 0, okay, and hopefully we're going to be at 12 quite soon. Like our colleagues at TNFD are talking about, right? They want to be rapid in getting this out there. The same thing that we're doing. So we've been doing conservation management for decades, working with the GEF, working with WCS that's here, and many other colleagues for many years. But we had never connected the dots with what Treasury does, and they issued $50 to $60 billion of bonds every year to support the work of the bank. Michael, he leads up the structured finance group, which that's a smaller segment, and they do very unique transactions that really can be those templates and those efforts to scale. But we had never combined and really got into a marriage between the two of us, and that's what we had to do for this transaction. So we had to get the highest level approval in the bank to go forward with this from the president on down. And then we had to get Treasury to work with us, understand, and get all kinds of new agreements in place, okay? So the three things that we could not do without, number one, is two agencies that have tremendous track record, and they were selected out of a group of 130. These two agencies and these two sites were selected because of their track record, their management capacity, and the performance that they have on the ground. So Great Fish River Nature Reserve, as well as Ado Elephant National Park, they deserve all of the credit for managing those rhinos, having great relationships with the communities, and bringing these benefits to bear. Second, it's Vanguard investors like Steve and the others who participated, because it's a new thing. It was new for everybody. And now we've had a lot more calls and support from other investors who say, we didn't invest in this one, but now we're excited about it because you got us talking about it. We got us to understand this risk, and now we were excited about doing more of these deals. So we need that. And the last one, which is really kind of, I think, the essential piece, is without the non-grant instrument that Avro leads, okay, and the support that we had from our good friend Gustavo, who unfortunately passed away early this year, we would not have this piece, right? So the big important funds that the countries provide to the GEF and the support for the NGI program are essential to making this happen, okay? So we want more grants, and if you have a grant, use it, okay? We don't want you to do anything with that grant. If you can leverage the grant or these new mechanisms such as the NGI, which are meant to test some new and innovative products, then leverage that to do some bigger transaction. And the only way that we're going to fill this $700 billion biodiversity finance gap is if Steve and the other many partners that are beginning to get more engaged over the last few years really put in big funding, okay? So we think that the risk is certainly manageable. There's always going to be risk, but there's risk in Bitcoin, right? There's risk in my iPhone not working. Whatever the issue is, we get better over time and things improve. So what we really need is all of you to go back and really see, okay, this is what we do very well. How can we leverage that to do this new piece? And the more that we do that, and the more, my friend from South Africa here, we had a good conversation yesterday, and she's going to go back and try to drum up some new opportunities within South Africa. And that's really, at the end of the day, what we need is a blended set of products, investments, and we need to mobilize all of this so that we really scale these efforts going forward. And our good friends there in the back, Valerie Hickey taking a picture, and my boss, Christian Peters, their support to allowing us to do this was essential. And the great work that Lisa Fairway does with the Global Wildlife Program, you know, that was really what laid the foundation for all this effort. So Avro, thanks to you, and thanks to all of you for all your efforts. And please take, you know, ideas with you and make the transactions work. We need to really do bundles, we need to do regional approaches, and we need to find effective ways of really, you know, getting this to the market. So thank you for all your support. Look forward to working together.
Thank you. Thank you all. We will stay around for networking questions if you want to talk to the panelists or myself. And thank you for being here this morning. Thank you.